Hello everybody, welcome back to the Finance Channel. Today we are going to look at something very important that happened this week and that is currently going on in the markets, while I will also try to teach you some basic and more advanced economics that come with this little story. Now, as you can see right here on the screen, we are looking at the S&P 500 and every candle represents 1 week. And as you can see, the index has been going down, down, down. And as you can see, this is something I'll teach all of you. I learned this from a YouTuber called Adam Koo, and I find it a good way of explaining it. The market usually follows what's called a breathing pattern. Breathe out, breathe in, breathe out, breathe in, breathe out, breathe in. It moves in that kind of cycle, you know? In, out, either up or down. That's something you see happen very often. And we currently have this kind of pattern forming, which is also known as a descending triangle, which is overall a bearish thing, aka not a good thing, but depending on what happens here at the end, either below or above, it could be either good or bad. But as you can see right here, we've been going down, boom, hit the ceiling, down, boom, hit the ceiling, down, established a floor called a double bottom, and then boom, went above it. We'll need to see what happens this upcoming week, if this will actually hold, but this is very positive. And we've seen for about 2 days, 2 days straight, it was above it. Yesterday, it broke above it. And the day after, it held above it. Now we need to see if it wants to continue to hold above it, because as you can see here, sometimes it goes above and then it goes down and it just fails. So you also always need to watch and see for a couple of candles. Usually every candle represents a day in the chart at this point. I would wait a couple more days. So like next week, 5 more candles to see if it actually wants to remain above. And if it remains above, that's a good sign, because it means that the market will go up from this point around, let me see, you take this, 4,800, you take the low, 3,600, which is around 1,200. That's the area you take. It would go up or down that amount usually with this trading pattern. And we are currently sitting at 4,000, which would 4,000, 4,100, something like that. So that would mean that the index would most likely go to 5,200 or 5,300, somewhere in that neighborhood. If this pattern actually completes and it goes in our favor, aka it breaks above instead of below. Because if it goes below, we could go much lower. But so far, it's looking very good. However, why is this even happening? Well, let's look into that. Now, all of this is happening because of one thing. The Federal Reserve is becoming more loose. They're calming down and are nowhere near as aggressive. And this is pushing what's called the US dollar index down. The US dollar index is nothing more than, let's see here. The US dollar index is a measure of the value of the US dollar relative to a basket of foreign currencies, which basically shows how the dollar is doing compared to other currencies, which affects the price of stocks. Because if the dollar is worth more, then stocks will become less valuable, because holding the dollar is a very good strategy all of a sudden. Aside from that, you'll see that companies who operate worldwide will make a lot less money in US dollars from foreign countries. For example, the euro used to be worth a lot more compared to the dollar, but the euro has basically gone down in value compared to the dollar around 10 to 20%. And so their earnings in Europe in dollars are a lot lower thanks to that. And so the earnings go lower and therefore the stock becomes less valuable. So the dollar, the strength of the dollar is actually very important for stocks because of those two reasons. First of all, if the dollar becomes more valuable, then it's worth holding the dollar or bonds, which are dollar denominated and pay out in dollars. And secondly, earnings from other countries that have different currencies that have gotten weaker and less valuable compared to the dollar, will make less money from international trade. As you can see right here, the US dollar index was actually on one crazy bull run. If you actually look up just the US dollar index, for example here on Yahoo Finance, and look how it goes up and down and compare it to the stock market or cryptocurrency or gold or silver, almost anything, you will see that it has an inverse relationship, aka the US dollar index goes up and all the other assets go down. All the other assets go up, the US dollar index is going down. It has an inverse relationship, aka it moves in the opposite direction of the other. As you can see right here, and currently we're on 1 week candles, so every candle here represents 1 week. It has been on a crazy rally higher, thanks to the Federal Reserve tightening and increasing interest rates, especially compared to all the other countries which haven't raised interest rates that much or at all even. And you can see it has been on a major bull run, however, it has broken the line right here. And now it has gone lower, a lot lower. And I don't think it will reach these levels anytime soon again. And it will actually do exactly what happened here. You know, it had a gigantic rally here. It kind of topped out and it went lower. It finicked around a bit and then it dropped. Here, it went higher, reached its peak. Then it dropped lower. It dropped below the line and then it just tanked. And I think that will happen again because it's a common thing that we see. However, why is that even happening? Why is the US dollar index weakening at all? Why is the Fed doing any of this stuff? Well, if we look into this article, you can see that the Federal Reserve wants to raise interest rates by 50 basis points, aka 0.5%. 1 basis point is 0.01%, instead of 75, which they have been doing recently. As you can see right here, the Fed funds rate has actually been going higher at a insane speed, to be honest. And this makes borrowing money of any kind more expensive. For companies, for people who want to buy stocks using leverage, aka lend money, for people who want to buy houses, people who want to start businesses, anything. So this kind of slows down the economy and makes bonds more valuable because this stuff is also correlated with the yield of bonds. The higher this goes, the more percentage of interest payout you'll get every year from bonds. And so bonds will become more attractive than stocks, and so everything comes down. However, now that they are saying that they want to slow down, the dollar index has kind of peaked and knows, all right, our glory days are over, we're going back to normal levels. And this is very good for stocks, as you can see, and even other stuff like crypto, silver, gold, almost anything really. And now for a little bit more context, the Federal Reserve will downshift in December to deliver a 50 basis point interest rate hike, but economists polled by Reuters say a longer period of US central bank tightening and a higher policy rate peak are the greatest risk to the current outlook. So while the Federal Reserve will not necessarily stop raising rates, they are seeing that they are getting close to their target. Because as you can see from the point here below, and I've discussed this in other videos, inflation is finally coming down, which is good, because that's the goal of the Federal Reserve at this point. The Central Bank of America is the Federal Reserve. And they are seeing that things are going in the direction that they want, but they want to remain firm and strict, and so they will raise interest rates even more. However, it looks like we are seeing the end of the tunnel. And usually when the Federal Reserve sees the end of the tunnel or holds rates, like aka holds them steady, that's what I mean by holding rates, they just kind of remain in place, you usually see that they reverse course and go back down. As soon as they stop raising rates and they pause, it is almost always, historically at least, almost always been the point where stuff goes down again. Now this might come with a recession, but this period can still be a period where you can make a lot of money. Because usually, because the Federal Reserve is calming down, and especially now because the economy was doing well, you will see some sort of last hooray. You know, everybody is like, oh my god, interest rates are going down or staying the same, and the people can spend money and know that they won't pay insane interest on it, and people can invest more normally knowing that stuff won't get any more expensive, talking about interest rates, of course. And then people will buy. And we are seeing the exact same here. And you also see like the dollar index weaken, you see bond rates weaken, all that stuff. And that's the stuff that really makes the economy go. Because if there's cheap money everywhere, then companies can borrow that money, invest that money, grow. Because there's no debt to be paid off anyway, because they grow faster than the interest rate, by far. This is what we actually saw during the period before this, because after 2008, interest rates went very low. And if you look at it, you can see that ever since, this is 1 year candle, so every candle is a year. Interest rates went to 0% basically, or almost zero, after the 2008 financial crisis, and stocks went hallelujah. And so if that happens again, it will allow stocks to go hallelujah once again, including crypto and including gold and silver, which all of which I hold. You can check out my eToro portfolio if you want to know what I hold exactly. My eToro portfolio is in the description down below. But it clearly shows that the market might be busy with what they call the pivots, the turnaround, the twisteroo. And I think the chances of that happening are high because the economy overall is still quite strong. Like, more negative numbers are coming in, but it's still incredibly resilient. And now finally the Federal Reserve is stepping out of the way, allowing the market to roar higher once again. So personally, I see this as a good thing. If you haven't gotten invested into the market yet and you have money on the sideline, now would be a good chance to chop it up into 3 pieces, let's say $3,000. So you take $1,000 of that $3,000, invest it now, wait for a bit, and then if you see another opportunity, you do the other 1,000, another opportunity, the other 1,000. You always invest in steps, so you have an average buy-in. Now, thank you all so much for watching. I hope you enjoyed this video. Be sure to check out my other videos, because I have more, even some shorts, so be sure to check them out. Those have some more basic concepts as well. If you have any video suggestions, leave them down below, and I hope to see you all in the next one. Also, if you have any questions, leave them down below and I will answer and provide any information or links that you need.